May 2024. A 30-year Treasury auction fails to attract sufficient demand at expected yields. The Treasury Department accepts higher rates to clear the auction. Dealers are forced to take down 24% of the offering, double their typical share. The headlines report routine auction results. The bond market notices something different. By November 2024, the pattern accelerates. Bid-to-cover ratios declining. Auction tails widening, foreign participation falling, dealer inventories rising. The plumbing underneath Treasury auctions is shifting in ways most analysts dismiss as temporary volatility. Here's what the routine auction coverage misses. The United States government now pays over $1.1 trillion annually in interest on the national debt. That's more than the entire defense budget, more than Medicare, more than any discretionary spending category. And that interest bill is rising because the buyer base at Treasury auctions is fundamentally changing. This isn't about the debt number. The debt number has been large for years. This is about recognizing when demand weakens at the mechanism that funds government operations, and what happens when yields must rise to attract the marginal buyer. The Treasury buyer strike isn't a headline event, it's a plumbing event. And plumbing failures show up in mortgage rates, corporate borrowing costs, and the silent wealth transfer from savers to the government through financial repression. By the end, you'll understand why Treasury auctions matter more than debt headlines for your mortgage rate and cost of living. How the four-stage buyer shift model reveals where stress concentrates in funding markets. What bid-to-cover ratios, auction tails, and dealer takedowns signal about demand exhaustion. Why Britain 1931, the 1970s bond crisis, and emerging market funding stress provide the pattern template. Where today's auction indicators place the U.S. in the buyer shift progression. How the $1.1 trillion interest bill forces policy choices that reprice mortgages, credit, and imports. The 5 quiet signals showing stage 2 transitioning to stage 3 in auction plumbing stress. Let me show you the pattern that repeats every time a major government loses pricing power in its own debt auctions. Stage 1, foreign demand softens. This is the quiet reduction phase. Foreign central banks and sovereign wealth funds reduce Treasury purchases gradually. The decline isn't dramatic. Monthly purchase volumes fall from historical averages but remain positive. Domestic institutions absorb the difference with minimal yield impact markets. Interpret this as portfolio rebalancing or temporary geopolitical positioning. The Treasury still clears auctions at expected yields. This stage can persist for months or years without triggering concern. Stage 2, domestic institutions absorb at higher yields. As foreign demand continues declining, domestic buyers, banks, pension funds, insurance companies, asset managers must absorb larger shares of each auction. But they demand compensation. Yields rise incrementally to attract sufficient bids. Auction tails widen, meaning the clearing yield exceeds pre-auction expectations more frequently. Bid-to-cover ratios decline from historical norms. Primary dealers increase their takedown percentages. The system still functions, but at higher cost. This is where the United States sits today. Domestic absorption occurring, but requiring yield concessions. Stage 3, banks and Fed backstop. When private domestic demand proves insufficient even at higher yields, the banking system and eventually the Federal Reserve step in as buyers of last resort. Banks purchase treasuries despite thin profit margins because regulatory requirements and liquidity needs compel participation. The Fed may restart quantitative easing or expand balance sheet operations despite inflation concerns. This is fiscal dominance, monetary policy constrained by government funding needs rather than price stability mandates. Yields stabilize but at elevated levels that stress other markets. Stage 4, pricing power loss. The government can no longer dictate borrowing terms. Markets set the price. Auctions face outright failures or require dramatic yield spikes to clear. Refinancing costs for maturing debt exceed revenues allocated for debt service. Policy choices narrow to austerity, inflation, or financial repression. Refinancing costs for maturing debt exceed revenues allocated for debt service. Policy choices narrow to austerity, inflation, or financial repression. Import costs rise as currency weakens from funding stress. Credit markets reprice based on sovereign risk rather than assuming risk-free baseline. This is the terminal phase where funding stress becomes visible economic crisis. Where is the United States today? Deep stage 2, with early stage 3 signals appearing in dealer behavior and term premium dynamics. The system still functions, auctions clear, but the plumbing is stressed in ways that compound rather than resolve. In September 1931, Britain faced a fiscal crisis that forced abandonment of the gold standard. The immediate trigger wasn't military defeat or revolution, it was loss of confidence in government debt auctions. Foreign holders, particularly French and American investors, began demanding gold for British bonds. The Bank of England's reserves couldn't satisfy redemption requests while maintaining the fixed exchange rate. The mechanism was invisible to most observers until the breaking point. Bond auctions throughout 1930-1931 showed declining foreign participation and rising yields. In January 1930, the Treasury placed $100 million in consols at 4.5% with strong foreign demand. By June 1931, similar offerings required 5.2% yields, and foreign participation had fallen from 45% to under 25%. The British government initially dismissed this as temporary volatility following the 1929 crash. Treasury officials assured Parliament that foreign confidence remained strong. This interpretation proved catastrophic. By summer 1931, the pattern accelerated. Bid-to-cover ratios fell below norms. Underwriters took larger positions than anticipated. Foreign central banks began net selling rather than buying. The funding mechanism sustaining the British Empire was breaking down, yet official statements continued minimizing severity. The crisis culminated in September 1931 when gold reserves fell so low that maintaining the peg became mathematically impossible. The Bank of England had lost $200 million in gold reserves over 8 weeks attempting to satisfy redemption demands. Daily gold outflows accelerated from $2 to $3 million in July to $10 bust and $15 million by mid-September as confidence collapsed. On September 21st, Britain suspended gold convertibility. The pound sterling, the world's reserve currency for over a century, lost 25% of its value within months. The wealth destruction was immediate and severe. British bondholders who had considered gilts the safest investment watched their international purchasing power evaporate overnight. Import costs exploded. Living standards for the British middle class eroded through currency devaluation rather than direct tax increases or spending cuts. The government reduced debt burden by destroying creditors' wealth. The lesson isn't that America faces identical circumstances. Britain operated under a gold standard the U.S. abandoned in 1971. The lesson is that credibility shifts occur through funding market mechanics before they manifest in headline crises. Foreign buyers reducing participation, domestic buyers demanding higher yields, central bank forced into backstop role, sudden break in currency credibility. These are the stages Britain experienced. The auction plumbing broke before the system broke. Between 1965 and 1981, U.S. Treasury bondholders experienced one of the most severe wealth destructions in American financial history. Not through default or haircuts, but through negative real returns, as inflation exceeded bond yields year after year. Investors who purchased 30-year Treasury bonds in 1965 at 4.5% yields watched inflation accelerate to 13.5% by 1980. Their bonds lost 67% of purchasing power despite receiving every promised interest payment and principal redemption. This is financial repression, government reducing debt burden by inflating away the real value of fixed-rate obligations. The mechanism started with buyer exhaustion. As deficits rose to fund Great Society programs and Vietnam War spending, Treasury auction demand weakened foreign central banks, which had accumulated dollars under Bretton Woods, began questioning whether bonds yielding 4 to 5% adequately compensated for dollar devaluation risk. In 1968, foreign participation in Treasury auctions averaged 35-40% of issuance. By 1975, this had fallen to 20 to 25% as international investors recognized the inflation dynamic. Domestic institutions absorbed the difference but demanded higher nominal yields. The Treasury faced a dilemma: allow yields to rise, worsening deficits, or suppress yields through Fed monetary expansion, fueling inflation. The Federal Reserve chose inflation. From 1965 to 1981, the Fed maintained accommodative policy despite accelerating prices. Fed Chairman Arthur Burns testified to Congress in 1975 that raising rates sufficiently to control inflation would trigger unacceptable increases in government debt service costs. Bondholders bore the cost. Middle-class savers holding Treasury bonds, municipal bonds, corporate bonds, all experienced wealth destruction through negative real returns. A 30-year Treasury purchased in 1965 for $10,000 matured in 1995 with $10,000 principal plus interest. But that $10,000 had the purchasing power of roughly $3,300 in 1965 dollars after cumulative inflation. The government's debt burden as percentage of GDP declined not through fiscal discipline, but through inflating away real obligation value. This is the documented playbook. When buyer shift creates funding stress, governments choose between austerity or inflation. Inflation is politically easier. Cost shows up in purchasing power erosion rather than explicit tax increases. Retirees living on fixed bond income saw living standards erode yearly. Insurance companies holding bond portfolios faced solvency pressures. Pension funds discovered safe government bond allocations, couldn't meet future obligations. The wealth transfer occurred silently through negative real returns rather than dramatic default. Bid-to-cover ratios for 10-year and 30-year Treasury auctions have declined from 2.6, 2.8 averages in 2020, 2021 to 2.3, 2.5 in 2024. This measures total bids submitted relative to securities offered. Declining ratios indicate weakening demand relative to supply. Auction tails, the difference between the clearing yield and pre-auction when issued yield, have widened. Historical averages show tails of 0.2 or 0.5 basis points. Recent auctions frequently clear 1.0, 1.5 basis points above when issued, indicating weaker demand than dealers anticipated. Indirect bidders, a category dominated by foreign central banks and international investors, have reduced participation from 65-70% of auction volumes in 2020 to 55-60% in 2024. This 10-15 percentage point decline represents hundreds of billions in reduced annual demand. Primary dealers, the banks obligated to bid at Treasury auctions, have increased their takedown percentages from 15-18% historically to 22-25% in recent auctions. Higher dealer inventories indicate insufficient private demand at expected yields. Dealers hold these positions briefly before distributing to clients, but elevated inventories signal distribution difficulty. These aren't dramatic failures. Auctions still clear. The Treasury raises necessary funds, but the mechanics reveal stress. Each marginal weakening compounds. Weaker bid to cover leads to wider tails. Wider tails discourage participation. Lower participation increases dealer takedowns. Higher dealer inventories pressure secondary market pricing. The feedback tightens incrementally. Term premium, the extra yield investors demand for holding longer maturity bonds versus rolling short-term securities, turned positive in 2023 after years of negative or zero readings. Positive term premium indicates investors require compensation for duration risk rather than accepting zero or negative premium. Rising term premium reflects uncertainty about future inflation, growth, and policy. When investors doubt the Fed's ability to maintain price stability while accommodating fiscal needs, they demand higher yields on long-dated securities. This is the market pricing fiscal dominance risk, the possibility that monetary policy becomes subordinate to government funding requirements. The United States faces significant refinancing needs over the next 24-36 months. Approximately $9 trillion in Treasury securities mature between 2025-2027, requiring rollover at current market yields substantially higher than the rates on maturing debt. This creates a maturity wall. As low-yielding debt issued during a 2020-2021 matures, the Treasury must refinance at 4.5% yields instead of 1.12%. The interest bill rises even if total debt outstanding remains stable. This is the treadmill effect, running faster to stay in place. The $1.1 trillion annual interest cost in 2024 reflects only partial repricing. As the maturity wall approaches and more debt rolls over at current yields, the interest bill could exceed $1.4 or $1.5 trillion annually by 2027, even without deficit increases. Fiscal dominance signals appear in Federal Reserve communications and policy decisions. When the Fed discusses balance sheet reduction or quantitative tightening, but proceeds cautiously due to market functioning concerns, that's fiscal dominance. When policy rates remain below inflation, despite price stability mandates, that's fiscal dominance. When Treasury auction stress triggers Fed interventions or slower tightening, that's fiscal dominance. The Fed has an explicitly stated subordination to fiscal needs, but actions reveal constraints. The central bank cannot ignore government funding stress without triggering auction failures that cascade through financial markets. This constrains policy independence regardless of official mandate. Real yields, nominal Treasury yields minus inflation expectations, provide crucial signals about investor confidence. When real yields fall despite rising nominal yields, it indicates investors expect higher inflation that erodes purchasing power faster than yield increases compensate. Recent dynamics show nominal 10-year yields around 4.3-4.5% with inflation expectations around 2.3 or 2.5%, producing real yields of 1.8-2.2%. These positive real yields seem healthy, but the trend matters more than the level. If inflation expectations rise faster than nominal yields, real yields compress, signaling investor doubt about inflation control. When bondholders fear the government will inflate away debt burdens, they demand higher nominal yields as protection. This can create a spiral. Higher yields increase government interest costs, necessitating more borrowing, further weakening auction demand, requiring even higher yields. The feedback becomes self-reinforcing once credibility erodes. The $1.1 trillion interest bill matters because it forces policy choices that show up in household finances. Every dollar paid in interest is a dollar unavailable for other purposes: infrastructure, education, defense, social programs. As interest consumes larger budget shares, Congress faces difficult trade-offs: cut spending, raise taxes, or allow deficits to rise further. Cutting spending is politically difficult. Each program has constituencies defending it. Raising taxes is politically difficult. Voters resist explicit tax increases regardless of party. The path of least resistance is allowing deficits to continue while the Federal Reserve accommodates through monetary expansion. This accommodation shows up as inflation, not dramatic hyperinflation, but persistent erosion of purchasing power that compounds over time. For middle-class households, this manifests in specific, measurable ways. A family purchasing a home in 2024 faces mortgage rates of 6.5%, 7.5%, even after the Fed began cutting policy rates because Treasury yields remain elevated due to auction stress. That same family in 2020 could have obtained 2.5%, 3.5% rates. On a $400,000 mortgage, the difference is approximately $1,200, $1,900 monthly in payments, $418,000 annually in additional housing costs driven by Treasury market dynamics. Savings in money market funds and short-term bonds appear to yield attractive nominal returns of 4 or 5%. But when inflation runs 3 to 4%, real returns are minimal or negative. A retiree living on $60,000 annual bond income sees purchasing power erode by $1,800 to $2,400 yearly if inflation exceeds bond yields by 3 to 4 percentage points. Over a 20-year retirement, this compounds to devastating wealth destruction. Corporate borrowing costs rise in tandem with Treasury yields. When Treasury yields rise from 3% to 4.5%, corporate bond yields rise from 5% to 6.5%. Higher borrowing costs slow business expansion, reduce hiring, and constrain wage growth. The middle-class worker doesn't receive a pay raise because their employer faces higher debt service driven by Treasury auction stress. Import costs increase as dollar weakens from funding concerns. When international investors doubt Treasury stability, they reduce dollar holdings, weakening the currency. A 10% dollar decline translates to 10% higher import costs for consumer goods, electronics, automobiles, energy. The family grocery bill rises not because food became scarce, but because the currency funding mechanism is stressed. The wealth transfer is silent. No explicit tax increase appears on paychecks. No dramatic crisis announcement interrupts normal life. Just persistent erosion of purchasing power while nominal values appear stable or even increasing. This is financial repression in practice. Government reducing debt burden by ensuring bondholders and savers receive negative real returns, while wage growth lags inflation. The mechanism operates through the plumbing of Treasury auctions. Weaker demand requires higher yields. Higher yields increase government interest costs. Higher interest costs constrain policy choices. Constrained choices lead to accommodative monetary policy. Accommodative policy during supply constraints creates inflation. Inflation erodes bond returns and household purchasing power. This isn't conspiracy. This is the documented playbook governments follow when funding stress intersects with political constraints on explicit austerity. The pattern repeated in 1970s America, 1990s Japan, 2010s Europe. The stages progress predictably. Foreign reduction, domestic absorption, central bank backstop, pricing power loss. Here are 5 signals to watch in 2025, 2026. Signal number 1, bid to cover ratios for 10-year and 30-year auctions falling below 2.2 on sustained basis. Signal number 1, bid to cover ratios for 10-year and 30-year auctions falling below 2.2 on sustained basis. This indicates private demand exhaustion, requiring dealer backstop or Fed intervention. Signal number 2, auction tails consistently exceeding 1.5 basis points. This shows the clearing yield significantly exceeds pre-auction expectations, indicating weaker than anticipated demand. Signal number 3, indirect bidder participation falling below 50% of auction volumes. This signals foreign buyers reducing participation below critical threshold, where domestic buyers cannot fully absorb. Signal number 4, primary dealer inventory of treasuries rising above historical norms for extended periods. This indicates distribution difficulty and insufficient end buyer demand. Signal number 5, term premium on 10-year treasuries rising above 100 basis points. This reflects investors demanding substantial compensation for duration risk, signaling fiscal dominance fears. Next episode, the dollar bypass isn't a headline event. It's a plumbing event that shows up in settlement systems, reserve composition, and trade invoice currency before it manifests in exchange rates. Here's where the stress appears first, and what it means for import costs and credit availability. The pattern is documented. The sequence is clear. The only question is whether you recognize the buyer shift before yields, force the recognition on everyone through mortgage rates and living costs. This isn't about predicting the future. This is about recognizing when auction plumbing operates outside sustainable parameters and understanding what historically happens when governments lose pricing power in their own debt markets.